It's Dr. Paul coming at you from my Fortress of Solitude. Today I'm going to bring you some new content. The first video in a series of what I hope to do regarding whether or not comic books represent a good investment. And we're going to sort of do a deep dive on the topic. We're going to look at comic books as an asset class, and we're going to evaluate them in the way that a rigorous investor should evaluate any potential investment. The reason why I feel compelled to do this series is because I think in our comic book collector community, we throw around the term investment. I'm investing in this. This is an investment. Comic books are an investment. We throw the term around very liberally, and frankly, I don't think it's justified. I've been doing some research on the topic. The first example that I could find of the use of the term investment for comic books is here by Robert Overstreet. This is volume 3 of the Comic Book Price Guide. This is from 1973. Okay, so Robert Overstreet, who I am a fan of and who I think did a lot for this community, and I think also ultimately we'll get to which comic books may be a good investment. And I think if there are some that are good investments, it's largely due to the work of Robert Overstreet. That said, in 1973, he starts calling comic books an investment. This was the earliest reference I could find to anybody calling comic books investments. But he uses the term, doesn't define it, doesn't defend it, doesn't actually do any of the work to really justify saying that comic books are an investment. I mean, I could tell you that, anything is an investment. If I can't demonstrate through data that it's a reasonable investment, it's really not very meaningful. So that's the purpose of this video series. Today, we're basically just going to do the groundwork. This is episode 1. We're going to talk about definitions. Might be a little boring to some, but I hope that what it does is it creates a framework for our dialogue, and that this is really the foundation for any conversation that we want to have that's rigorous about comic books as an asset class. And so let's get started. So really basically, what is an investment? An investment is an asset that is purchased with the expectation that it will generate revenue or appreciate for future profit. I think most folks understand that. It does start to get tricky if you look at asset classes that generate not only appreciation but also generate revenue, and you have to think about them a little bit differently. That becomes a little bit more complex. The other thing is, anytime you talk about an investment, you have to talk about the time horizon, and the time horizon differs for each investor's need. Short time horizons demand lower risk, and that means that you typically expect to have a lower return on investment. This is basically this concept that everybody understands. You can't get rich overnight, right? So also, as you retire, as you say, for example, the best example of this is, as you're approaching retirement, you shift your asset allocation from riskier assets that have higher returns on investment to less risky assets that have guaranteed but lower returns on investment. So the most, the most well understood example of this is, when I'm young and I'm working, I have my whole life ahead of me, and I want to start investing. I might start with something like 80% stocks and 20% bonds. I might even go 90% stock, 10 or even 100% stock in my portfolio when I'm young and I have my whole career ahead of me. But as I approach retirement, I'm going to be shifting more and more of my assets into bonds, and in fact, as I reach retirement, I may be 80% in bonds or even 100%, right? And so the time horizon matters. I think for us, the biggest thing about the time horizon is that it helps us define whether or not something is an investment or a speculation. We also hear that term thrown around a lot in our community, spec, MCU spec. This is spec for me. I'm speculating on this. And that's fine. The basic definition here of an investment is typically an investment is longer term. Long term, it could be just 6 weeks, it could be 6 months, but typically it's measured in years. If we're talking about something that we think is going to appreciate in a short time period, say less than 6 months, typically, but somewhere around one day or even sometimes minutes out to perhaps a few years, that's speculation. So we're not thinking that that asset is going to appreciate sort of naturally without a catalyst. We're expecting some kind of catalyst to make it pop up overnight, right? And so that is an appropriate use of the term speculation. So if you purchase a comic book because you either have some inside knowledge or you trust somebody who has inside knowledge, or you just have a gut feeling that, hey, this character is going to be big or this character is going to show up in the MCU, you purchase that book with the expectation that it's going to appreciate dramatically kind of overnight when people become aware of it. That's speculation. And that has to do with the time horizon. So anytime any serious investor considers an asset class, they have to review the different attributes of an investment. So the first thing is expected return on investment. Then what risks am I taking with my money? How volatile is the asset? How liquid is the asset? What are the maintenance costs of maintaining the asset for as long as I expect to have it? And what are the trading costs of purchasing or selling the asset? And so we're going to go into each of those. One of the most important concepts of investing is the opportunity cost of capital. And people, even in normal investing circles, do not talk about this enough. So the opportunity cost of capital is this concept that says the return of the next best use of capital is what you always have to benchmark your investment against. This concept works out like this. In economics, there's a concept just called opportunity cost, and I'll just take a moment to describe that. So let's imagine that you went to work for a day, and your employer said, "I'll pay you $100 for your work today," and you worked 10 hours, so you made $10 an hour. Now, a normal person might say, "I made $100 today," but an economist would say, "Well, did you actually make $100 today? What other things could you have done with your day?" If there was another opportunity for you to work that 10 hours and make $120, and let's say there are no other costs associated with it, like let's say you worked in this store and the store literally right next door, you could have just walked in the other door 10 feet away, you could have made $12 an hour. So you could have made $120. An economist would say you didn't make $100 that day. You lost $20 that day. Because the opportunity cost of working in the store that only paid you 10 was that you didn't get an opportunity to work in the store that paid you $12 an hour. So that's called the opportunity cost. In investing, this is a really important concept. If you have an expensive Silver Age comic book, say that comic book is worth 10 grand today, in today's market. If it goes up by 5% this year, and at the end of the year it's worth 10,500, you might think, "Oh, I made $500." But an economist would say, "Well, wait a minute, how much did the S&P go up this year?" If stocks went up 10% this year, then you didn't make 5% on that asset. You actually lost 5% on that asset. Because that 10 grand, if it would have been in, for example, the S&P 500, it would have went from 10 grand to 11 grand. So it's a very important concept, and it's the concept that we'll use, that any rigorous investor uses to evaluate an investment, and we're going to apply this to comic books. And as far as I can tell, is anywhere in terms of within the public domain, anything that's been published, anything I could find online, no one's ever done this. So I've already sort of briefly mentioned it, but the benchmark for all investments is the Standard & Poor's 500, or also known as the S&P 500. The Standard & Poor's 500 is the listing of the 500 largest companies by market capitalization in the US stock market. And it is, again, just it's the best investment you could have been in the last 100 years if you reinvest dividends. And so it is the standard benchmark by which all other investments need to be compared. And so we're about to jump into that. All right, so what we're going to do is we're going to take each of the 6 attributes of an investment asset class that I explained. And I could have picked others. There are other attributes that are worth talking about, but I think these 6 main ones capture what we need them to capture in terms of whether or not we can evaluate comic books as an asset class. So the first and most important one for most investors is return on investment, or expected ROI. So return on investment is what's happened in the past. Expected ROI is what we expect to happen in the future. So it is basically just how much the asset has either appreciated or depreciated. It is usually expressed as a percentage return per year. And again, this is pretty basic. I think most people understand this. If a stock is $100 on January 1st, 2020, and on January 1st, 2021, it's worth $110, then we would say the return on investment was $10. That's the sort of gross return on investment before we consider costs. So with stocks, that is essentially the return on investment because the costs are essentially zero to maintain a stock in your portfolio. But with comic books, there's actually costs associated with holding it. And so we'll get into that a little bit. So what is the expected ROI of the S&P 500? The average return on investment over the last 100 years for the S&P 500 is about 12% per year when you reinvest in dividends. So what that means is I'll do a little bit of a sidebar here. There's a rule of thumb called the rule of 72. What that means is if you take the number 72 and you divide it by your percentage return, that you will get the number of years that it takes for an asset to double in value. So take the number 72, divide it by 12, you get 6. What that means is effectively what most people need to understand is that the S&P 500 essentially doubles, an investment in the S&P 500 essentially doubles every 6 years. So if in 2014 you invested $10,000 in the S&P 500, on average you would expect that asset to be worth in 2020 about $20,000. Obviously, you hear this all the time. Past performance does not guarantee future performance, and we understand that. And I haven't actually looked to see what the S&P 500 did over that 6-year period. But over long time spans, we can expect it to continue to perform similarly because it has done so for many generations, right? And my great-grandparents could have invested in that. They could have the same expectation that I would have or that my parents or grandparents have. So in that context, what is the expected ROI of comic books? This is actually the biggest question we're going to tackle, but we're not really going to tackle it today because it requires a lot of deep dive, a lot of data analysis. I have already done that data analysis, so I already know the answer. But basically, it depends on many factors, including the type of comic book and your time horizon. We're going to explore all of that in greater detail in future episodes. And that is really the heart of what is going to determine whether or not comic books are a good investment. The other attributes matter, and they impact ROI. But ROI, ultimately, at the end of the day, is what determines. Time horizon matters because I think we've all seen this. Sometimes there's the best example is, say there's a new hot book, and you could buy it maybe for cover price at your local comic shop today. You might be able to flip it tomorrow for $20, right? But if you hold that comic, maybe it gets cold. Maybe 3 years from now, it's back to cover price. Maybe it's less than cover price. Maybe it's in the dollar bins, right? So time horizon matters with return on investment. If you have books that are hot now, that are experiencing a lot of demand, it is typically, in a lot of cases, it's the best thing to do is to sell. And time horizon does matter, and we'll get into that again more in future videos. The next attribute is risk. So risk is basically, what could go wrong with my investment? How could I lose my investment? Typically, we expect higher risks on things that return higher ROI, and things that have lower ROI, we expect lower risk, bottom line. So again, stocks and bonds are great examples of this. Stocks have greater risks. They can go up, they can go down. Things can happen. Companies can just go bankrupt, right? And so we need, in order to justify an investment in stocks, we need a higher return on that investment because things can go wrong. Whereas with bonds, typically you purchase a bond and it appreciates over time, and then when you go to sell it, you get the bond plus the coupon, which is the percentage that the bond paid. So if a bond is going to pay out 3% over, I think you can get about 3% on a one-year bond right now. You invest $1,000 on January 1st, and January 1st of next year, you expect to get $1,030. And there was either no or very little risk. If the bond is in the U.S. government, you could argue there's zero risk, but the risk is much lower. It really doesn't depreciate during that year. It's just an asset that's appreciating as the year goes on, and so that's how we have to think about comic books as well. The S&P 500 again is just like the stocks I explained. In that it's an asset class that has values that can go up or down. So it can appreciate, it can depreciate. The risk of complete loss is extremely low. If we look back at the last 100 years of the what would be the S&P 500, but essentially the American stock market, we have several instances where the S&P 500 fell by 60 or 70% of value. But it's always come back, and in fact, it's always come blazing back, so that if you sold at that moment, you missed the greatest opportunity for the next 10 or 20 or 30 years in investing. If you needed the money in that moment at the bottom of the Great Depression or at the bottom of the stock market in the Great Recession, it was a bad deal for you. If you needed to liquidate on that day, yeah, your money was cut in half or maybe worse. But as long as you had a long time horizon, which is why time horizon is important, in fact, those were just blips on the radar. And 5 years later, not only had you recovered all of that loss, but you had actually appreciated dramatically since then. So the risk of complete loss is very low. And the risk of a physical loss of the asset is literally zero. Nobody actually carries stock anymore, physical stock. It used to be back in the day, you would buy stock in a company, they would literally issue you stock. They would send you a piece of paper. It looked, like an official document. It was stamped by a seal, etc. But nobody does that anymore. Now you just hold them electronically, and at your holding company or your broker. So you don't have to worry about losing the stock in a fire, or because termites infested it, or a flood, or theft. Somebody, breaking into your house and stealing your stock. It doesn't happen anymore. It's all held electronically. So those risks are all now zero for the S&P 500. Comic books, in contrast, are physical things that we have to lug around. So they have the first risk of the asset can either appreciate or depreciate. Now, to be fair to comic books, they do happen to be less volatile, and we'll talk about that in a minute. So they do happen to depreciate less than, say, stocks when stocks are taking a hit. But they're subject to all of the things that can happen with a physical object, right? So for this asset class, you've got to carry them around. They're physical things. You can lose them to flood, fire, theft, termites, and other insect infestations. There's even a really great example of losing a comic book to a disgruntled ex-lover. Google that and go find it. It's kind of a sad but hilarious story. So there are risks to holding physical items. And you can carry insurance. I do that. There are specialized insurance companies. You can basically insure your comic books for about 1% per year of the value of your comic book collection. But if you do this, it reduces your expected return on investment, right? It's another cost that has to be considered in the ROI. So it does, this fact, even if you take out insurance, makes comic books less competitive as an asset class for investing. So the next concept we want to talk about is volatility. I've already touched on it a little bit. But volatility is the variability of an asset's value from day to day, month to month, year to year. So I think people understand this concept pretty well with the stock market. We usually talk about it when the market's going down, but technically it's the market going up or down. If you look at the S&P 500, you can just map it. You can do statistical analyses on what the volatility is. One way to do that is to measure the standard deviation. Standard deviation is you can think of it as the average amount that the stock market moves in 2/3 of the years that you study. So that means there are outlier years where it moves more than that. There are outlier years where it moves less than that. But that's how you sort of should think about the standard deviation. So in most years, in the majority of years, the S&P 500 moves up and down by less than 15%. There are, of course, outlier years. But in a typical year, you can expect the S&P 500 to move up and down less than plus minus 15%. Here is one attribute where comic books compete rather favorably with the S&P 500. Comic books have lower volatility than stocks do. Recently, we saw 20% reduction in the S&P 500, and comic books generally did not take that big of a hit, especially blue chips, especially in-demand books. However, one important thing with volatility that we should discuss is what's known as asset correlation. What that means is that it's always a good thing to have assets in your portfolio that move the opposite direction of the stock market. So when the stock market's going down, that asset's going up. And so if you have the majority of your money in the stock market and the stock market's doing poorly, this other asset that you have appreciates during that time. And you say, this is nice. You can sell that asset while it's up. You can take those proceeds, that capital that you raised, and you can purchase the stock while it's down. So it is nice to have assets that are not correlated, that are decoupled. Bonds typically historically acted this way, where bonds would go up as stocks go down. In the most recent sell-off in the stock market, unfortunately, bonds went down as stocks are going down. But the typical behavior, and that had to do with a bunch of things going on in the economy. The typical behavior is that they actually go in opposite directions. Comic books are more or less correlated with the S&P 500 in terms of, when the S&P is going up, comic books are going up, or when the S&P is going down, comic books are going down. That doesn't it doesn't really get into how much they're going to go up. Like we don't expect, for example, S&P goes up 10%, comic books go up 10%. They're not coupled in that way. But generally, when the S&P is trending up, comic books are trending up. The next attribute that we are going to discuss is liquidity. And liquidity is just the ease of turning the asset back into cash. Again, you might need the cash because, there was a storm and your roof leaks, or your kids need to go to college, or any number of things that happen in life, right? You may just be retiring and you need capital now because you're not working anymore. The nice thing about the stock market now and the stock exchanges now and the things we can do on these devices is that stocks are extremely liquid. I could decide right now that I want to sell $1 million worth of stock in the S&P 500. I can pick up my phone and I can sell that stock in less than 60 seconds. It's incredible. As long as the market is open, I should say. Comic books are not that liquid. They're more liquid than some assets. I mean, they're certainly more liquid than a car, a collector car, or some other things like real estate that you could invest in. So I think that they have moderate liquidity. Liquidity is better for slabbed books because now it's sort of a known commodity. That's why getting books slabbed has really changed our hobby. And the advent of slabbing books about 20 years ago, has dramatically changed how liquid certain books are. Blue chip keys are also more liquid because there are certain books that are always in demand. There will be somebody, if you need cash, that will step up and buy your ASM 129 in any environment. Now, they may be willing to pay less for it today than they were willing to pay yesterday, but there will always be a buyer for that book. There may not be a buyer for, run-of-the-mill non-key books on any given day. So those books are less liquid because at any given moment, there are fewer buyers than there are sellers of non-key books. So just something to keep in mind, how quickly can you get your capital out of the asset, and that's liquidity. Comic books are less liquid than the S&P 500. Maintenance costs are basically simple, just the cost of maintaining the asset. For the S&P 500, that's zero. Again, it's a digital asset that sits at my broker and my brokerage house, and I don't have to do anything to maintain it. It doesn't cost me anything. Comic books, again, are physical assets, so we have to store them somewhere. If you have a large collection, you literally have to have a room devoted to them, right? So there's a cost associated with that. If you have a family that normally would need a 3-bedroom house, now you need a 4-bedroom house. That's real, right? That's going to cost you how much in your housing market, I don't know, but it's going to cost you something. Or it's almost cliche now if we watch these Storage Wars and other shows like that, where somebody had to take all their comic books and dump them in a storage facility somewhere, because they're physical assets that you have to lug around. There's a true cost associated with that. Now, if you're a single guy, you have an apartment, it's a 2-bedroom, you got some space, maybe you don't think of that as a true cost, but it still is. You could have taken on a roommate if you didn't have that room filled up with comic books, right? That roommate could have generated revenue for you. So it's a real cost, whether you want to think about it that way or not. And if we do a rigorous assessment of comic books as an asset class, we need to consider it. You also have to have environmental control. So let's say you have the space, let's say you have a barn or a basement, but it's not well controlled in terms of the environment. So humidity is high or temperature is high, and your books are going to degrade. And so they're not going to be a good investment if they're degrading over time. That's one of the risks we talked about. You're going to have to pay for electricity. You're going to have to pay for an air conditioning unit, a dehumidifier, something like that. Those are real costs. And we also have bags, boards, boxes. If you use the typical polyethylene bags and the normal buffered boards that only have buffering on one side, you've got to replace those every 5 to 10 years or they will degrade your comic books. And so that's another real cost. And lastly, I mentioned that we can have insurance to defray our risk, but insurance is a real cost. We don't have any of those costs associated with carrying stocks. All of these costs are drags on our investment. So again, if the S&P goes up 10% in a year and we have a comic book that also appreciated 10% in a year, but we had all these costs, the comic book didn't perform nearly as well as the S&P. So typically maintenance costs are much higher for comic books than they are for the S&P 500. Trading costs are also much higher. Basically, trading costs are just the cost of acquiring or liquidating an asset. And we have to consider for comic books both of those costs. For the S&P 500, they're essentially free. It used to be that there were trading costs. You paid a fee. You paid an additional fee per share. You used to have to call your broker up on a physical phone. I've been investing long enough that I remember doing that, but none of that's true anymore. I think it's true that essentially all brokerages now offer free trading. I know I trade with Charles Schwab. It's entirely free for trading stocks and ETFs. I do pay very small fees for trading options, but they're reasonable and in line with the rest of the industry. So essentially, trading stocks is now free. It's not true of comic books. And one of my rules of thumb is if I'm buying a comic book, I essentially need it to double to just break even on my investment. And this is why. If you calculate the true cost of holding a comic book for some period of time, first when you purchase it, when we look at price guides typically use fees that were paid just for the comic. They don't include tax or shipping or buyer's premiums. Buyer's premiums are not something we face most days, but there are certain auction houses that apply a buyer's premium. I estimate purchasing fees somewhere between 10 and 20% typically. They can be higher than that, again, under certain rules with certain auction houses. But like here, I live in the Austin, Texas area. Tax is 8.25%. So it's almost 10% just that I'm giving to the government when I purchase an asset, like a comic book. And then shipping has to be added onto that, right? If it's one thing about shipping is it's fairly fixed cost. I mean, if you buy insurance, it can go up a bit, but the cost to ship a $1 comic book is approximately $8 or $10, and the cost to ship a $1,000 comic book is approximately $8 or $10. I mean, maybe again you're going to ship it priority and you're going to insure it, so maybe it costs 15 or $20. But costs to ship are fairly fixed. So this 10 to 20% is for a relatively inexpensive comic book. For a more expensive comic book, this might be slightly lower, because the cost, if a comic book costs $1,000 but it only costs 20 to ship, that's a much higher, or that's a much lower percentage, right, of the overall cost of the asset. But that's on the front end. On the back end, selling fees are typically higher than purchasing fees. So again, they vary. It depends on what platform you use. I use Shortboxed, I use eBay. There are other platforms you can use. Typically, your seller fees include the fee that you have to sell to the platform that you sold it on, and then potentially any fee you have to sell for the money handling. So PayPal, for example, charges a fee for you to use them. So when you add those costs up, again, you're in the realm of 10 to 20%, typically higher than what you have for a purchasing fee. So I think of this as anywhere from 13 to 20, and again, it could be higher than 20 for certain assets. That's if you have blue chip keys that you can sell easily. I put here that selling fees can be more like 80 to 90% for non-key comics that are liquidated in bulk. And the reason I put that is it's not a true selling fee per se, but it's just to recognize the fact that if I've got long boxes of non-key books that are just bulk, if I want to take those if I want to get rid of them and I need to do it quickly, I'm going to take them to a local comic shop. The reality is they're going to give me somewhere between 10 and 20% of the value. And that's reasonable for them because it's going to take them years. They're going to have to sort them all. They're going to have to rebag and board them. They're going to have to put price tags on them. They're going to have to open them up. They're going to pay somebody to look through and make sure the Marvel value stamps are cut out. All those sorts of things, grade them. Then they have maintenance costs on their facility. They have to pay employees. They have to make that money up. And so they cannot pay you more than 80 to 90% of what is considered the retail value of a non-key comic book. That they have to bear all those risks, and they're going to have to sit on that comic for years probably before they sell it. So for non-key books, the costs of selling are extremely high. But if we take the example of just a blue chip key that we purchased, our purchasing fees, let's imagine on the high end, are about 20%. Our selling fees on the high end are about 20%. That means, say that I purchased a book worth $100, right? And it's a key book, so it's something that's fairly liquid, that's kind of always in demand, right? I add my purchasing fees on, that's 20%, so it's now cost me $120. I also had maintenance costs, right? Because I held it for some period of time. Whether those are real or whether they're just the cost of risk and et cetera, I do carry insurance, et cetera. Let's just say those maintenance costs are another 5%. So now I'm up to $125, and I want to try to sell that book. Well, let's imagine that my seller fees are around 20%. That's not outrageous if you use eBay and you use PayPal. 20% of 125 is another almost $25. It's $22.50. So we add those up. The cost, the actual cost of me acquiring and selling that book are something like over $150. Well, I purchased it for $100, but to purchase it and then to sell it again, it's going to cost me over $150. So for me to sort of even just break even on the book, it's got to go from $100 to $150. For me to profit, it's got to go higher than that. So these trading costs are real. They're a very serious drag on return on investment, and there's something you need to consider. If you purchased a comic book that's worth $100 and you see tomorrow there's news and it popped up and now it's worth $150, congratulations, you broke even on that comic book. If it didn't go up and it's still only worth $100 and you need to liquidate it, you didn't break even. You lost money. You lost about 40% of your money on that asset, and that's not a great deal. So the S&P 500, again, we see outcompetes comic books on trading costs as well, fairly dramatically. So I think this video may already be longer than most people can tolerate, but I do think it was an important sort of foundation for the conversation that I want to have to continue with the comic book community. And so in summary, to consider comic books as a legitimate investment, they must be considered as any asset class is. And we have to evaluate them based on the attributes of an investment. And we started to do that today. The S&P 500 is the benchmark for opportunity cost of capital for a reason. The historic returns double approximately every 6 years. That's very difficult to outperform. So again, spoiler alert, most comic books are not a good investment. And we'll demonstrate that over future videos. So thanks for your attention. I appreciate it. Looking forward to hearing from people in the community. Leave comments below. Tell me I'm an idiot. Tell me how much money you made. Come at me. It'll be fun. And until next time, enjoy the hunt and take care of one another.